there seems to be a reticence to put data in front of the board if it's not complete and if it's not accurate. And I think we're in a journey where we have to be courageous and we have to be innovative. And this is more about direction of travel rather than full accuracy to 100%. So in my previous experiences, I have pushed the teams and myself to put data that was providing sort of direction of travel, but maybe may not have been sort of 100% watertight.
Can adaptation finance be used by banks to manage physical climate risks? And if you have any interesting examples to share from your experience from UNEP FI role, and what is the role of data to support this?
Yeah, I'm actually very glad that this is also part of our topic, because when it comes to climate and climate strategy, we tend to talk, for good reasons, a lot about climate change mitigation, how urgently we need to reduce emissions in the real economy, which is of course all true, but we tend to forget that there is also the adaptation angle. Physical climate risks are already basically on the agenda of banks and also their regulators. So banks already need to address physical climate risks, but there are many different ways to address physical climate risks. And of course, there are some which are more helpful for the adaptation, let's say, of the country or regions or communities or clients. And there are some others which are maybe perfectly suitable, at least on the short term from a risk management perspective. We can maybe mention risk avoidance, exiting certain client relationships, stopping to finance certain clients or certain collateral types in very specific territories, maybe subject to flood risk. Well, the problem, of course, with adaptation finance is there are much less clarity on metrics. When it comes to greenhouse gas emissions, which is probably the most important metric, of course, for climate change mitigation, this is, of course, this metric has its depth and that has its data challenges. We can talk about, and I'm sure we will be talking about this. But for adaptation, there is no single metric. There is very difficult to come up with good KPIs for adaptation. How can a bank know if it's already doing a good job in terms of adaptation finance?
How far are the banks in assessing their data needs to inform their strategy setting and risk management, to identify the gaps compared with current data and to devise a plan to overcome these gaps? How far would you consider the banks have come? And if I may, additional sub-question, what have been the developments like in the last year in terms of addressing these data gaps?
Well, I think it's been a big journey, and as mentioned before, banks have evolved from a top-down approach to a more granular approach. So once they have assessed the maturity of a certain of the risk in a certain region or in a certain sector, they go deeper in analyzing the risk at counterparty level. And this has been allowed by increased disclosures by companies, by the development of also proxies by external providers, and by the development of engagement policies as well, because you cannot have all of your clients covered by external providers. So I think banks have started that dialogue with the clients on both transition risk and physical risk, and that's very important because, as Manuel said, I mean, the intention is not just to drop, the clients which are at risk, it's to help them transition, maybe from the decarbonization perspective or from the resilience perspective. And that's very important. And that's what we want to do as the climate bank, is to accompany our clients in that journey. So I think right now we are in a position where we have a mix of external data, internally collected data. We have to make sure it's consistent. And then to close the remaining gaps, we have proxies which are of different levels of quality. And what's very important, I would say, is to be able to use that data for some meaningful decision-making process. So when it comes to credit, which is my field, it's how will it impact our assessment of the probability of default of the LGD. How do you do with that in terms of pricing, contractual clauses, etc. But then also, how does it inform your strategy in the end? What do you want to make to do with this with these clients? Do you want to set limits? Do you want to set targets and to revisit the relationship after a while? So yes, I would say risk and strategy are very much intertwined, and we are in a position where we have different sources of data that we have to reconcile and ensure the consistency of.